Answer yourself the question: what do you want from trading? Really, what is it what you want from trading? Why you started trading, or why you want to start trading? Answer yourself honestly to those questions. Doing something just for sake of doing it and without any purpose or goal will not get you anywhere. To depression maybe. Set yourself clear goal why you started trading. However, your goal must be realistic and clearly measured. Why you started doing this? Is it money? Freedom? You want to prove something to yourself? Or you tired a 9 to 5 routine? Common phrase I heard by the way. It might be that you started getting the details of trading because you heard or saw somewhere incredible lifestyle traders lives and ridiculous amounts of money they are making. But it is a thing disguised. Once again about these promoters. We are manipulating you. We don't want you to become better, wealthier, or whatever. Once you will put your money in it, it's over. I understand that the tale of a beautiful and easy lifestyle sounds good, but life doesn't work that way. So it is something like this. Life will punish you if you chase these things. Don't be fooled. Anyway, from most people, I believe it is money, to be honest. Whatever it is, you must be realistic with yourself. For example, to make 10k monthly income in a year from now is not realistic, even though it's possible. But I don't want to give you bad hope. It will take some time, buddy. More reliable goal would be to cover my living expenses from trading alone in a 2 or 3 years from now. Is way more realistic. So, are you ready to dedicate that much time and efforts? I suggest not to set exact time when you want to achieve your goal. It will put just another psychological pressure on your shoulders, as we spoke already. And that is what you need to avoid. Also, be realistic with yourself. I know that to make 5 times bigger salary of average salary in your country in a year from now sounds good. But that just not going to happen. Everyone was making this kind of money already, if it would be true, and our society would collapse. Your reward reflects your effort, so more effort you will put, better reward you will get. Remember this. But it doesn't mean that effort and stubborn is all you need. It will help, of course, but it's not the answer. You need to think what you're doing as well. I will not extend too much on this topic. Answer yourself honestly to questions above, be realistic about it, and do not believe in fairy tales. How to enter markets, trade calculation and types of orders. As an individual, you can enter market for secondary parties, which mostly will be brokers. After choosing your broker, you have to be familiar with data broker provides, trading software. Download trading software to your computer or trade it directly there at web, but it is easier to download that. Then choose your trading products, whichever it is, stocks, futures, crypto, ETFs, forex, whatever. Simple as that. But there is quite a few orders, which you need to know before start trading. There are 3 main types of orders used for trading: market order, stop order, buy stop, sell stop orders, limit order, buy limit, sell limit orders, and there is a few more, but these mostly used for investing. Market order. A market order is an order to buy or sell a financial product at the market's current available price. A market order typically ensures execution, but it doesn't guarantee a specific price. Market orders are optimal when our primary goal is to execute the trade immediately. A key component of a market order is that the individual does not control the amount paid for the stock purchase or sale. The price is set by the market. A market order possesses a high slippage risk in a fast-moving market. If a stock is heavily traded, there may be trade orders being executed ahead of yours, changing the price you pay. This type of orders guarantees that the order will be executed, but it does not guarantee the execution price. A market order generally will be executed at or near the current bid for a sell order or ask for a buy order price. Usually, market orders are used for securities with a large volume of trade. We include large capitalization stocks, futures, exchange trading funds. Stocks that have very little average daily volumes are not in high demand for a market order. This is because we have wide bid-ask spreads, owing to the fact that we have small volumes of trade. Moreover, trades for thinly traded stocks can result in significant trading costs. This is because we are executed at unexpected prices. The process of placing a market order is considered pretty basic. The orders are executed as soon as possible at a given price of a security. It is as simple as a hitting buy or sell button on a trading software to successfully execute the order. Whenever a trade executed at market order, we are willing to buy a security at the ask price or sell the same security at the bid price. This means that any person executing a market order ends up giving up a price difference between them. It means bid-ask spread. Let's get to the chart and place a market order. Here it is a market data at 5 minutes time frame at MetaTrader trading software, which is not the most comfortable one, but when you get used to it, it's okay. Whichever trading platform you are using or going to use, there is some small box with highlighted buy and sell buttons. At this specific platform, it is at the left upper corner. As we spoke already, market order is executed by hitting one of these buttons, considering whether you want to buy or sell. Then, choose your product. In this exact example, it is Dow Jones 30 futures market. Then, choose your contract size, and you are ready to place an order. Market orders are usually used for scalping strategies. Anyway, let's place an order randomly by simply pushing the buy button. That is it. Our trade is active and opened, as we can see below on our screen. In order to close a position, we can simply click X sign at the position right here, or by clicking right mouse button on a position at the chart and then choose Close Position. Simple and plain. I repeat once again, that these actions can be ever so slightly different at different platforms, but the idea remains the same, and whether you will get slippage or not depends on market volatility, as we spoke already. Stop order. A stop order, also referred as a stop loss order, is a trade order designed to limit and therefore protect a trader's loss on a position. A stop order sells a stock when it reaches a certain price. Although a stop order is generally associated with a long position, it can also be used with a short position. In that case, the stock will be purchased if it trades above a stop order price. For example, trader is considering selling a stock if it declines to $75 from its current price $78. The trader could place a stop order at $75. When the stock hits $75, the order will be executed. Note that the stock will not necessarily sell at exactly $75. It depends on the supply and demand of the stock. If the stock is rapidly falling, the order may be executed at a price significantly lower than $75. In other words, it's called slippage. Or, if trader is considering buying a stock if it rises to $78 from its current price $75, the trader could place a stop order at $78. When the stock hits $78, the order will be executed. Let's get to the chart and place a few stop orders. Here it is the same market. Stop order is way different than market order. At this order, you need to choose exact price on which you want to sell or buy the product. Let's say we want to buy at some specific price. We click on Tools, New Order, at Type, choose Pending Order, then again on Type, choose Buy Stop Order. It means that we can set this specific order only above current market price. And if it would be sell order, then we can set sell order only below current market price. Let's say we want to buy at this specific price. Accordingly, set stop loss and take profit. Let's say we want to get 100 points of profit and protect ourselves by setting stop loss of 40 points. When everything is ready, press place. Our order is ready and waiting to be activated, and it will be activated only when the market price hits stop price. When we are setting stop buy order, it means we are expecting price to climb even further after hitting our order. Same would be with stop sell order. We are expecting price to fall even further after hitting our order. Limit order. There are two basic execution options available to trader who is placing an order to buy or sell a stock. When the orders are placed at market, we are called market orders. When the orders are placed at a limit, we are called limit orders, because we are subject to constraints set by the trader. Limit orders allows a large degree of control to traders and their broker. Traders are able to set maximum ceilings for acceptable sales price amounts, ask price, and minimum ceilings for acceptable purchase price amounts, which is bid price. Unlike market orders, limit orders are well suited for securities with medium or small market capitalization, low trading volumes, and wide bid-ask spreads. A limit order is a trade order to purchase or sell a stock at a specific price or better. A limit order prevents investors from potentially purchasing or selling a stock at the price that they don't want to. Therefore, in a limit order, if the market price is not in line with the limit order price, the order will not be executed. A limit order can be referred to as a buy limit order or sell limit order. A buy limit order is used by the buyer and specifies that the buyer will not pay more than specified price per unit of a financial product, with specified price being the limit order set by the buyer. For example, considering a stock whose price is $51, trader sets a limit order to purchase 200 shares at $48. And in this scenario, only when the stock price hits $48 or lower will the trade execute. A sell limit order is used by the seller and specifies that the seller will not sell a share under the specified price per unit of financial product, with specified price being the limit order set by the seller. For example, consider a stock whose price is $51. Trader sets a limit order to sell 200 shares at $54. In this scenario, only when the stock price hits $54 or higher will the trade execute. Let's get to the chart and place few limit orders. At this order, same as the stop order, you need to choose exact price on which you want to sell or buy the product. Difference is that you can set your buy limit order only below current market price and sell limit order only above current market price. It means when we set sell order, we are expecting market to climb up to this exact price or more and then fall up to our target. Let's say we want to sell at some specific price. We click on Tools, New Order, at Type, choose Pending Order, then again on Type, choose Sell Limit Order. Then set our stop loss and take profit accordingly. Let's say we want to get same 100 points of profit and protect ourselves by setting stop loss of 40 points. When everything is ready, press place. Our order is ready and waiting to be activated. When market price will hit our specific price, order will be activated. And if price continues to climb forward, our stop loss might be pulled and we will incur loss. However, if price turns around, our profit might be pulled as we are expecting. As it was mentioned above, there are few other types of orders, which is mostly used for investing. These are trailing stop order and stop limit order. Let's cover these two shortly. A trailing stop order is similar to stop order. However, a trailing stop order is based on the percentage change in the market price as opposed to a specific target price. Although a trailing stop order is generally associated with a long position, it can also be used with a short position. In such case, The stock will be purchased if it increases by the determined percentage. For example, an investor purchases a stock at the price of $25. The investor places a trailing stop order of 20%. If the stock declines 20% or more, the order will be executed. A stop limit order is a conditional trade order that combines the features of a stop and limit order. A stop limit order requires placing two prices, the stop price and the limit price. Once the stock hits the stop price, the order becomes limit order. Stop limit orders, as opposed to the stop order, guarantees the price limit. On the other hand, a stop order guarantees the order execution, but not necessarily at the stop order price. For example, an investor currently owns a stock trading at $90. The investor would like to sell stock if it dips below $65, but only if the stock can be sold at $64 or more. The investor sets a stop limit order by setting a stop price at $65 and the limit price of $64. Once the stop drops below $65, the order becomes a $64 limit order. Thanks so much for watching, and if you found this video helpful or interesting, please give it a thumbs up. It really helps the channel to grow. And if you'd like to see more content like this, make sure to subscribe and hit the notification bell so you don't miss any future videos. I would also love to hear your thoughts or questions in the comment below. Thanks again, and I'll see you in the next video.